Most people don't tell the whole truth, even to their doctor. Lots of people do. But a lot of people, when that question, how many drinks do you have a week? I had a bad week. Was it 12 or was it 3 or was it none? And a lot of people fudge some of those things. And that's where the pattern can change. And you have to look at the pattern, which is why you want a historical record. We go back 3 to 5 years, sometimes farther, because a lot can change in 3 to 5 years. But it all goes in the system. And the question then becomes, Adam, will those systems release it? Because the use case for which we need that data is comprehensive.
This is the Buried in Work podcast, where we share tips and interview experts to help you simplify estate planning and end-of-life tasks.
I'm your host, Adam Zuckerman, and today we are joined by Chris Conway, a leading expert in the life settlement marketplace. With over 30 years of hands-on experience, Chris brings a wealth of knowledge about life expectancy assessments and how life settlements can serve as a valuable financial tool for both individuals and businesses alike. His expertise helps dispel common myths and offers practical guidance on how to make informed decisions in this often misunderstood industry. A lot of people know what life insurance policies are from a high level, but the reality is they have no idea how it works behind the scenes, and Chris is an expert in explaining that. Chris, it is wonderful to have you on the show today.
Pleasure to be with you, Adam. Thank you very much.
Yeah, it's great. Let's hop in. So,
sure.
What the heck is the life settlement industry? I'm sure that when somebody asked you when you were in middle school or high school what you want to be when you grow up, that was not top of mind.
It was not bottom of mind. It didn't exist. The life settlement industry is a marketplace in which consumers who have life insurance that they no longer want or need, if they qualify, can sell it as an asset. Life insurance basically belongs on the asset side of a personal balance sheet, but most people think of it as a liability. It's not well understood, as you said. Life settlements evolved from the HIV/AIDS epidemic, where a population of people that had a very effective network of communication had life insurance that was given to them mostly by their employers, from the federal government on down. But they had no need for the death benefit. What they needed was money to pay the rent, buy groceries, pay for drug therapies that weren't yet FDA approved, and things of that nature, end of life issues. And a market developed first as a function of a philanthropic exercise, people just giving money to people that they knew that were in this situation. But eventually it became a commercial activity as a function of needing to raise more and more money. And then in the late 90s, the people involved in that business identified another population that had a limited and ascertainable life expectancy. We could evaluate and calculate it. And that was the senior population across the country, which is much, much larger. And from there, the market has grown, although it's still not widely known. It's a very, very, very niche business with tremendous potential. But again, the instrument that we work with is something that a lot of people own, but they don't really understand how to wield it as a weapon against financial need or want, and the ways in which they can transact that asset for their own benefit.
Now, when you say it's the industry that you work in, can you talk a little bit about ISC, your role there, just so people have a little bit of context of your perspective?
Sure. So over the course of my career in this business, which I happened into, which happens to a lot of people, I played pretty much every role. There are defined roles in the industry, and it's somewhat analogous to the mortgage industry. There are originators, we call them providers, there are brokers. ISC does two things in the marketplace. One is we evaluate life expectancy on what we call a micro longevity level. In other words, for the individual relative to their health condition, their age, their gender, their smoking status, and the specifics within their medical record. And the other thing we do is a lot of people call it servicing, but we are basically technicians who administer life insurance policies purchased by institutional investors. And we basically make sure that the premiums are paid. But when we onboard an asset, we take that watch apart as a technician, and we understand the interoperability of all the gears in the analogy, all the ways in which that product works, so that we can advise the investor when there are certain inflection points that increase or decrease its value. We're very good at collecting claims, finding out when people pass, dealing with life insurance, customer service organizations. And that leads us to do things, in the legal world that involve very technical analyses of life insurance products, because we work with those things all day, every day. And most of our due diligence work is forensic. We take it apart and figure out how it works, why it worked the way it did, what happened in the past, the provenance of the policy, and all those kinds of things. The life expectancy is the variable that drives value. So we've combined those two activities in our current enterprise.
I want to unpack the watch analogy in a second, because that's tremendously helpful, I think, for our listeners to understand when you're working with a larger portfolio. But before that, you mentioned that you help effectively understand what someone's longevity is as an individual. You mentioned smoking habits, for example. How detailed do you go into that? Are there actuarial tables involved? Is this something you can do in a matter of an hour or two, or someone just submits some information on a web form? Or are you really diving in to say, oh, you've got a family history of congenital heart disease, that's going to impact you?
It's a progressive exercise. So it's certainly possible to take self-reported data from a consumer and assume that it's correct, which is not necessarily very precise. If we talk about, for example, I grew up in the South where a lot of older people will say, well, my sugar's high today. They mean they have diabetes. There's a way of talking about that disease amongst the older population that sometimes is not particularly useful from an underwriting perspective. But what you start with might be self-reported data, which you assume to be correct, which puts you in maybe the state, hopefully the county in which they reside from a life expectancy perspective. But it doesn't get you to the zip code or the street or the specific house. If we go further, we get as much medical data as we possibly can, which in the US is a complex exercise in and of itself. And I would tell you that even though these platforms exist where you and I can go and get our medical records, a lot of that data is actually self-reported. So I live in the Northeast between two of the largest major metropolitan areas in the country. I'm part of a network from a fairly well-known Ivy League school just to my southwest. And yet some of the information in my portal for my primary care physician, whom I've seen for 20 years, I put there. So it exists in other places, but I had to put it there. And there are a number of networks. When we get that data, we break it down and organize it in such a way that an underwriter with specialized training in our field can look at that. And for example, you mentioned heart disease. Most people don't have just one thing that's called an impairment, something wrong with them. They have multiple things, and those things interact with each other, as do the treatments for those impairments. And you have to understand that sometimes, for example, a cancer will supersede heart disease, and other times it won't. Prostate cancer, for example, is extremely common amongst older age males, but it's often not the thing that ends their life. They die with it, but they've lived with it. And the thing that might end their life could be congestive heart failure, for example.
That's exactly what happened to my father. So he had prostate cancer after he was diagnosed with leukemia, and then he took care of the prostate cancer, and then leukemia came back.
Right. And those ebbs and flows and the impact of those impairments and the way in which they affect each other and then one supersedes the other are things that we have to understand, because a lot of people will hear, oh, they've got prostate cancer, and they think that's the thing that probably ended their life or will end their life. And one of the things that we're doing is we're looking at a snapshot based on the medical data. But the more we re-underwrite the lives, particularly in the life settlement market, which the life insurance industry does not do because they don't sell products to older age people. There's a cutoff.
Mm-hmm.
The more we re-underwrite, the more we can observe the change in the trajectory of the life expectancy because it's probabilistic. And then the calculation itself is using actuarial tables that have been adapted based on our body of work and other bodies of work that we can access, medical data that's called SEER data, where high-level physicians will study a particular disease in a very particular way, and they'll provide calculations and statistics about that, which we factor into our holistic analysis. Lifestyle, family history, and all those kinds of things obviously have a bearing, but then sometimes fate drops something into a life that will shorten their life expectancy dramatically, transplant opportunities, for example. But if they get the transplant, that trajectory immediately changes, their life extends. And the more people understand about how those things work, it enables better decision-making. On the investment side, the investor's simply looking at how long am I going to pay premiums before I collect death benefit for the life settlement. But there are a lot of applications that we think our marketplace has developed for other marketplaces. But we're a nascent industry in that sense, quite small, but with a lot of potential for growth in other areas.
As an individual consumer, how would I take advantage of that knowledge if I came to ISC and said, hey, I don't know what the heck I'm doing. I need your help. What's your response of step one, do this, step two, do this, and then we're going to be able to do, as a result of those actions, X, Y, and Z, or you'll have X, Y, Z services or products? And the question I'm about to ask you after that is, what's that workflow for companies as well? Because I imagine that it's almost a competing interest where consumers want to have the life insurance policy and maximize the value that they get out of it for what they pay. And it's a business on the other side. They're hoping that people live a lot less or shorter and they pay out less money. So how do you harmonize those two things?
Right. So if we're dealing with a consumer, which we're just starting to explore, because the output of the product is designed right now for institutions, but there are consumer applications. We're dealing with a consumer or an advisor with a consumer. The first thing you have to do is gather the information. A couple of years ago, there were probably 6,500 health information networks or exchanges. The exchanges are like landfills. Medical data is being dumped into these places, but there's no organization because there are people willing to buy a slice of the landfill and sift through it separately from these exchanges. So the exchanges are just aggregating data without really organizing it, without cross-referencing it, without scrubbing it. So when we go in, the first thing is you have to sign an authorization to allow us to gather the data wherever it might be. And it's called a HIPAA authorization. A lot of times when you go to the doctor, you sign a new one all the time. Some of them are compliant, some of them aren't. Obviously, we know the difference. Some states like California have additional privacy regulations that we have to consider, so separate forms and things of that nature. And some networks will not accept requests from a consumer for their own health record, even though the law says consumers own their health record. Assuming we can get past all of that, it's fairly easy to sign a HIPAA, and most people know who, generally speaking, they see for healthcare. Although sometimes it's, if you're part of a network and you go to the hospital and you see different practitioners from time to time, you have to start with the facility. We go out and we gather all that data, and there are expenses involved in collecting it. Some charge for it, some don't. Some restrict what you can get depending on whether you're a consumer or another healthcare organization. And we aggregate as much data as we can. It's rarely cost prohibitive. It can be anywhere from 100 pages. We've had cases with 15,000 pages of medical records. And we digitize it. We create a chronology to create a kind of medical history that's based on the passage of time because our health evolves as we do. And then once we do that, we create a summary that is hyperlinked in our case and quality controlled by humans. There's some technology and there's some human oversight here because the data is very noisy. For example, if your doctor ever accidentally checked the box that you were a smoker and you're not, it's going to be in there. And the preponderance of non-smokers outweighs that one smoker, but the system's going to pick up, wait a minute, they said he was a smoker. As an example, my father had a car accident when I was a child, but my mother smoked for 2 weeks while she waited in the hospital to see if he would live. She never smoked before. She never smoked after. But had a doctor said smoker, she was chain smoking out of nerves and stress and anxiety. So we filter that stuff out. It remains there as an indication of a possible error. And then we have an underwriter look at that data and use a proprietary underwriting manual, a guide relative to their experience, to go through that and score, called debit and credit, the records and the health history of that individual.
1 second, I've got a question there. So when someone goes to their doctor's office and the doctor says, how many drinks a week do you have? Are you a smoker? Oftentimes people think that they have patient, doctor confidentiality.
Correct.
If there is that HIPAA release that they sign, are you saying that the information that is disclosed to their doctor then goes into these systems that insurance companies can actually access? And how do you protect yourself if you don't want that information getting out? Because that comes as a surprise, I think, to a lot of people.
Yeah, it all goes into a system. And, my doctor used to write, now he carries a laptop. He literally comes in, plugs in, it goes to the server. Whatever I tell him is going to be in the record. Now, the first thing is most people don't tell the whole truth, even to their doctor. Lots of people do. But a lot of people, when that question, how many drinks do you have a week? I had a bad week. Was it 12 or was it 3 or was it none? And a lot of people fudge some of those things. And that's where the pattern can change. And you have to look at the pattern, which is why you want a historical record. We go back 3 to 5 years, sometimes farther, because a lot can change in 3 to 5 years. But it all goes in the system. And the question then becomes, Adam, will those systems release it? Because the use case for which we need that data is comprehensive. But some healthcare exchanges say, well, we're only going to release everything to other doctors who are not trained to do what we do. They're trained, but they're not trained to estimate life expectancy. And so there's always some variability in there because you ask for everything, but you get what they're willing to give you based on your description to the vendor of how you're going to use that information. Most importantly, you as a consumer should want to know what you said 5 years ago in the doctor's office.
No,
but
absolutely.
Sometimes you can't get it.
I think that there's a tremendous amount of value to have digitized records that physicians can share. I think it comes as a surprise and maybe even a disincentive to get people to provide accurate information to their doctors if the information that they're providing is going to impact their insurance premiums later. So if I knew that when you're doing your analysis, you're going to look at whether or not I'm a smoker or not, I'm not a smoker for those that are listening, I may say, no, I don't smoke at all because I don't want to have that impact. So is there any way that consumers, that individuals, when they go to their doctors, they can say, listen, I only want you to know this. I don't want this being sent over to an actuarial firm, to your firm, to figure out when I'm going to kick it?
In theory, they can ask that the information not be conveyed. The question then becomes, does the practice of that medical group enable an alternative storage mechanism for that information, which is important, right? If they actually smoke, but they don't want to. And the other issue is when you sign a life insurance application, you actually sign a statement that says that you've answered everything truthfully and that you haven't withheld material information that the carrier might use. So this is a really good reason to take good care of yourself, number one. And number two, these systems and these practices, these habits are not uniform across the country. For example, we had a conversation with a group in Australia where they have nationalized healthcare and a very small population, about 25 million people. They have a uniform data collection process, a uniform system. The data is very, very clean and same from one insured to another. But we don't have that here. We have, for example, older people typically see a doctor that's similar to them in age and background until they reach an age at which the doctor retires, they've retired, and the new kid, no offense, at 30 years old, comes out of Langone in New York, and their new doctor is 50 years younger than they are.
Yeah.
That experience, right, changes the nature of the relationship with, Doc, who said, yeah, I know you smoke a cigar every weekend with a, couple of fingers of bourbon, but I'm not going to put it in the system. The younger physician might have been trained in such a way that it's a data-driven world. We've got to collect accurate data. The more accurate the data, the better the treatment protocol, all of which is true. And they may not be willing to enable the management of what gets into the system in the same way that somebody generationally different might.
Understood. And I think that that's a very important distinction that you mentioned a few seconds ago, which is you're actually giving the insurance provider, when you're requesting a new premium quote or an update, to have access to the data. They can't just pull it without any.
No. There is an organization called the Medical Information Bureau, which is funded by about 2/3 of the life insurance companies operating in the States. And they keep some data. How many applications have you filed for how much death benefit with which carriers? Because there's a limit to how much life insurance you can buy.
Mm-hmm.
And we're not in the primary market of selling life insurance, but the MIB, as it's called, keeps that data for a period of time. It's almost like a credit reporting agency, so that you can run around to 5 different companies, apply for $5 million policies across all of them. But if they look at you from financial underwriting standpoint and go, there's no way this guy's worth issuing that much coverage on, they will communicate through that repository.
Mm-hmm.
Hey, this guy's applying for a lot of policies all over the place. He's only eligible for 10 million of coverage, and everybody will dial back what they might offer to issue. Now, in the secondary market, we're dealing with policies that have already been issued. They're no longer contestable, and they've been applied for. And the thing that we look at on the policy side of our business is that sometimes insurance companies aren't as diligent because they have legal remedy if they want to challenge a claim, for example, for fraud.
Mm-hmm.
So contestability is where they can't not pay the claim, for suicide or something of that nature after the second year. But if you committed fraud at the application and they discover it post-claim or in the process of a claim or in the process of collecting premiums from you, they can kind of decide when they want to take action with respect to that issue. The truth is most people don't do those kinds of things.
Mm-hmm.
They don't lie. They tell the truth. Even when they fudge on how many drinks a week, the doctor has some sense. And there are symptoms associated with alcoholism, for example, that if a guy has cirrhosis and he's 45 years old and he tells his doctor, I only had 1 drink this week, the doctor's going to go, come on, Todd, how many was it really? Because, they're trained to pick up on these things. And that information does get into the system in physicians' notes and things like that. And then we use that to assess the risk associated with that individual.
So there's a little bit of a fudge of if you're actively trying to take out a policy with blatant lies, blatant falsehoods, that's one thing. And that's very different.
Correct.
Okay.
I mean, I personally, have a friend who's from Ukraine. He lives in New York. If we get together for dinner, I'm not going for a blood test the next day because it's chicken Kiev and vodka.
They'll find traces of blood in your alcohol stream.
Exactly. And my doctor actually knows this guy's name. He goes, clearly you spent some time with Vladimir, I mean, I don't drink a lot, but if Vlad and I get together, I might have more than I should. The doctor's aware of it. It's in the system,
Mm-hmm.
But again, life insurance companies have been doing this kind of stuff for a very long time, and they have large numbers. What
Mm-hmm.
we don't have, right, is we're looking at every individual one by one, and each of them is unique. They are snowflakes in a way that have a unique pattern. And there are things that change the trajectory of their lives and their lifespan over time. Behaviors change.
Mm-hmm.
People did in college is probably not what they're doing when they're 70.
I got
Yeah.
one more question about individuals, then I want to shift back to the larger institutions that you work with.
Sure.
If an individual came to you and said, ISC, I'm interested in figuring out what my profile is. I want you to go through the exercise as if you were looking at me for the perspective of an institution, or I'm just curious what you think about me when I'm going to die. Is that something you guys do, or is that not something that anybody would ever ask for?
We are able to do it. We have not done a lot of it direct to consumer. It typically comes through an advisor. And the reason is that the advisor has an application for the output. In other words, so if I go see a financial planner,
Mm-hmm.
he has an incentive for me to leave something behind so he can manage the money for the heirs. But if my objective is to, forgive the expression, die broke, and books have been written about this,
Mm-hmm.
I want a much more realistic perspective on my possible trajectory based on my lifestyle, my healthcare, and so on. So it's not uncommon for a guy like me with a family history where no male in my family has ever lived longer than 88 years. But I go to my financial guy and he says, we're assuming 91 or 92. And he knows the business that I'm in. And I say, that's great. I don't know where you're coming up with that, but I can tell you based on my personal history, I'm, as an asthmatic as a child, we don't have to get into me, but I know that that is an overestimation of my likely life expectancy based on my knowledge of my own history. And I've not had my own LE evaluated. I could do it in a moment's time. But if I think it's less than that, I'm going to make different financial decisions than I'm going to make if I think I'm going to be around longer than is likely. And as I continually adjust my decision-making based on the trajectory that I'm on and how it might have changed, I can be more specific about those kinds of things.
Mm-hmm.
And we think there's some utility in that for a lot of situations that don't have anything to do with life settlements, but we are the variable that changes that valuation. If we move to the institutions, we can talk about what that means, but it's not a bad idea to have your own idea, for example, of what your house is worth,
Mm-hmm.
right? Most people only appraise their home when they're buying, selling, or borrowing. But Zillow, even though their algorithm had to be adjusted, was based on the idea that wouldn't you like to have a rough idea of what your asset's worth, the same way that you check the stock listings in the Wall Street Journal.
In a strange way.
And we do something analogous to that, but on a very specific area.
In a strange way, I can almost see a oddly morbid health insurance employee benefit where it's like, we'll give you a $50 reimbursement for your sneakers, for your gym. And by the way, we think you're going to die in 32 years. You should get your stuff together. You should sell into the marketplaces.
I mean, if you think about it, right? If somebody sat you down and said, if you don't stop drinking and smoking and staying out all night, you're going to carve 10 years off your life. People change behaviors as a function of knowing that.
Yeah.
And if they could observe the impact of those changes, granted, there's a lot of variability in this, right? Because you could step off a curb and it's over through no fault of your own. And that has nothing to do with lifestyle or health. But if you had a better idea of that,
Mm-hmm.
because a lot of people make assumptions about these things without really knowing what the drivers are. And again, some diseases don't affect everyone the same way, but popular culture and the way that these things are reported on a population basis, it seems like they would. And, we just individualize a lot of those things.
On the website in your FAQ, we did a fair amount of research just, prepping for the conversation. It says that you guys value expediency in addition to accuracy, which I think is meritorious. And the process is methodical, it's thorough, it's consistent, data-driven, important, and designed to provide with a complete report in 5 to 10 business days. When you're working with institutions, are they typically sending over a book of, hey, here's 15, here's 50, here's 100? What's the volume that you guys can push?
If you think about it, right, we're taking what we've learned about older age mortality and we're looking for other places to apply that knowledge. And the products are probably going to be different. But the volumes typically are driven by the volumes in the life settlement market. So you have two kinds of underwriting. Secondary market, where a new policy is being sold, and those are anywhere from 3,000 to 4,000 underwriting events a year at a minimum. It can be 5 or 6. Some of these things are affected. For example, people tend, when interest rates change the way they have recently, to stop, wait and see where they're going to settle before they do a lot of financial transactions. And life settlements is affected by that. Then you have what's called the tertiary market, where institutions are reselling, buying and selling amongst each other life settlements that are in their portfolios for a variety of reasons. Liquidity, they need to make distributions, they want to report profits or take profits. And this is before people have died and death benefits are collected. The policy values are changing as a function of life expectancy and the passage of time.
So the parallel then is, if you're looking at the mortgage industry, you own your house, you can sell your house, but somebody may have the mortgage on the back end that they
Correct.
can resell who holds your mortgage. Or you can take out a HELOC, a home equity loan on your house and take value out. So for this, the life settlement business, it's involving the sale of an existing life insurance policy. So you can exit all or some of it. Right. And the company that you're dealing with could also say, we don't want to have this policy anymore, the equivalent of the life insurance mortgage company, and they can sell it to somebody else. And you're helping on both sides of that equation in a way.
Correct. And there is no exchange for that, but there's an active tertiary market amongst the institutions that play. And what they'll do is they'll update the life expectancy so that the buyer and the seller, although they have different views, right? When somebody sells 100 shares of Apple, they think it's going down from where it is, usually, and the guy that's buying it thinks it's going up. So you have a buyer that reevaluates the life expectancy, or a seller that wants to know what they can expect to sell that policy for, and they come to us and we will evaluate that life. If we've seen it before, it's additive, right? We've got a better pattern or more of a pattern for that particular life. And if we've not seen it before, we're starting the first point in that pattern, and policies move around in the marketplace. We also track when people pass, and for the clients that we do administrative or back office work, we then will go and collect those claims and those kinds of things as well, which, by the way, tells us the degree to which the work that we've done in the past or that done by some of our competitors is valid. Right? In other words, if our predictions are off and the mortality curve for that person was very different than what we assessed it to be, that's a learning input that we then apply to the underwriting manual and possibly table adjustments, although adjusting mortality tables requires large volumes of output over a long period of time to justify. You don't just tweak the table every time. Some people seem to do that, but it's arithmetically invalid because there's nothing about a single data point that represents an actual pattern. It's part of a pattern. You just can't see the whole pattern.
Understood. Now, you mentioned identifying other opportunities where you guys might start shifting focus. One of the things that's mentioned on the website is senior living and senior living operators. Based on actuarial tables, older people tend to die more frequently than younger people. It's just the way that our bodies work.
Right.
How are you working with senior living operators, or is that just something that you guys are looking at right now?
We're looking at that market because what we know is that they're taking longevity risk. That is the risk of somebody living longer than expected. And the longer most people spend, vast majority of the money spent on healthcare at the end of their lives, right? If a real estate investment organization in the senior living space is taking longevity risk and they're not measuring it, they certainly can. Most of that industry right now is constrained, as I understand it, and I'm not an expert in the area, but it's constrained by a predominance of focus on the real estate aspect. That's where the money is made.
Mm-hmm.
However, there's a supply problem, right? There's not enough senior housing of the right kind. And, everywhere in the country, from 55 and older communities all the way through memory care, hospice, so on and so forth, that market needs capacity just in terms of space. But there's longevity risk embedded in each of the individuals as they move through that trajectory, the end of life living environment. However, most of what they're doing, and it's not a criticism in the moment, is that price, and this is true in the insurance business as well, price is kind of a blunt instrument for dealing with risk. In other words, if you know that there's risk there, but you can simply add to the price and the market will accept it, and you add such that it covers that risk or over covers it, really, you don't need to be that precise about price. But if demand increases and competition increases, the degree to which precision becomes more and more and more important over time increases as well, because you might not have price, or there is a ceiling on price, and then you look for ways to deal with the cost of the risk that you're taking. So longevity risk cost has to do with how much longer will a person be in a space with demand from the outside for that same space. What are the economics of keeping that person in that space? For example, a lot of the states are looking at the idea that if you don't qualify for a Medicaid bed, or if you do, there's only so much money to go around. In other words, if the federal government is pushing the costs onto the states and the states only have so much money, at some point, the money has to come from somewhere, ostensibly taxes, which again is not a criticism, but at some point it becomes really important to know how much you need, how to budget, how to legislate to make sure that the funding is there. Because the other thing that used to happen, and that a lot of people, at least anecdotally, fear, is that they're going to be put on the street when they can't pay anymore. Well, I don't think the government's going to allow that. It's very bad PR and a lot of other bad effects. But if you don't allow that, somebody has to pay for that care. You've got skilled nursing and memory care and very complex, care issues. I've got a friend that works for a company where they make a bed sheet that measures how frequently a person in that bed turns over, because bed sores are a big problem in high-end care for older age persons. And the technology is in development. But if you think about it, that's a pretty tight niche in the older age care marketplace. But it's enough of an issue, right, that measuring whether people are being turned over. The other issue is, if you don't have enough nurses on staff to turn them over,
what happens? And there's a cost to having nurses present to do that on a frequency level that makes sense from a care perspective. We're way off topic with respect to what we do, but I mean, that marketplace is starting to look at very precise things. And we think longevity risk is one of them that they will ultimately look at. No, that's helpful. And podcast listeners know we oftentimes talk about things that are tangential. I'm sure that your friend has also considered, camera vision, algorithms, XYZ to see, but there's privacy concerns there, but possibly easier to train a model to say this individual had this action as opposed to a physical sensor. But that's a conversation with Vlad over drinks another time. Now, navigating the market, let's shift back to consumers. We like to give people a tangible step or something to keep in mind. What should they consider if they're looking at entering the settlement marketplace, they have a policy, want to sell it, and are there any red flags or critical questions that they need to be asking?
That's a terrific question for a number of reasons. So the market is small but diverse. I would advise consumers about a couple of things. Number one, there is a competitive market, but it takes time to complete a transaction competitively. And there's also a direct-to-consumer option if you want to do something relatively quickly. So the analogy we used to use is we buy any car, we'll buy your car tomorrow for a price. It might not be the highest price, but if you want it out of the driveway or the garage, it can be a very quick, relatively easy, transaction. And a lot of people benefit from that. The other option is effectively to hire a broker, to have an advisor who knows that marketplace, and they are licensed in most states to represent you in the marketplace. You can represent yourself, but it's a very arcane marketplace with a lot of nuance, such that most consumers that try to broker their own policy end up with an advisor. It's not dissimilar to the real estate business, right? Most people still sell their house with a realtor.
That's a great tip there. But my question I'd push back on is there equilibrium. So to draw the analogies, which we like to use, the metaphors, when I sell a car or buy a car, I can buy it outright or I can lease. And generally speaking, when you look at the end cost of both, they're relatively similar, because if one was so much more attractive, people would do that versus the other. So they have to be on par. Is there a likelihood, and I don't know the answer to this, that if you were to sell your policy to WeBuyCars.com, the one you mentioned earlier, that even though it might be a lower rate, it's actually the same amount that you'll walk away with than giving, and I'm assuming, a commission or a fee to represent you to a broker?
It's the brokered transactions generally will fetch you a higher net, not in every case. And you don't have to choose one avenue. Right? You can approach the direct-to-consumer marketplace and know what you have to work with there while you're advised by an intermediary, and shop a little bit. You don't have to lie about it even. It's expected.
The brokers then are typically taking a percentage of sale or something. It's not.
They are definitely being paid a portion of the purchase price. That is correct.
Understood. So then they are incentivized to maximize as opposed to do. Okay.
Correct. And there are people that are fee averse, even if the net is greater. And the other thing is that the transaction takes some time. It's not dissimilar to buying a house and taking out a mortgage and so on. 90 to 120 days. Sometimes it can take longer. And some of these products are very complicated, number one. Number two, insurance companies are not in the business of paying claims, right? They're in the business of collecting premiums and hoping that you lapse the policy because you don't need or want it anymore. So they're not wanting policies to make it into the secondary market, albeit regulated, legitimate, longstanding, consumer-friendly business. And so it takes longer to do an intermediated transaction, which some people don't want to do because you got to keep paying premiums. You can't stop paying your mortgage because there's a for sale sign in the front yard. You got to keep paying until somebody gives you an offer. So, and there are hybrid transactions where you can sell part of a policy, typically the majority of the death benefit. So in other words, somebody would say, I'll buy 80% of the death benefit for X amount of dollars, and I'll pay 100% of the premiums. And when you pass, you can name a beneficiary, called a retained death benefit transaction, RDB. And people do that as well, where they don't want to divest all of their death benefit from their heirs, but they do want to stop paying premiums, and they do want to get some cash today to do the things that they want to do. And, the reverse mortgage business is not dissimilar in that there are a couple of different product types or transaction types that you can avail yourself of if you want to take some equity out of the bricks, mortar, wood, and steel, turn it back into cash, and take a cruise around the world or whatever it is that you might want to do with that money and still live in the property.
All right. This sounds like it could be a topic for a second podcast episode, how to exit and all the wonderful things you can do with the money that you earn. Chris, this has been absolutely tremendous. I imagine that many of the listeners are unfamiliar with this sector and this vertical, but it is unbelievably important for them to wrap their head around it. Thank you very much for taking the time. If people want to find you, if they want to connect with ISC, where can they go?
Our website is iscservices.com. You can find me there. You can send us an email, phone, fax, and we obviously can be found by professionals on LinkedIn as well, and all the usual corners of the internet. And we'd be delighted to talk to anybody about the life settlement business, what we do, and so on and so forth. I really appreciate the opportunity, Adam. I'm grateful for your time.
Thanks, Chris. Enjoyed the conversation. Have a great day.
You too.
Thanks for listening to another episode of the Buried in Work podcast. Remember, you can save 10% on our estate preparation package and games with code podcast10 at buriedinwork.com.